There is a hidden debt trap ticking down in the bank accounts of millions of everyday Americans right now, and it's being completely ignored by the financial press. This isn't about the usual exhausted debate over whether student loans should be forgiven or not. This is about what is actually happening to the money in people's pockets while they are distracted by the rising cost of everyday life. High interest rates and the fact that a bag of chips now costs $7 are capturing all the headlines, but they are masking a much deeper shift in the American economy. We are watching an unfolding wave of defaults, but the government has quietly thrown a heavy blanket over the data, hoping that if the public can't see the crisis, they won't have to manage the fallout. Think of college loans as an all-you-can-eat buffet of borrowed cash. You load up your plate for 4 years, you graduate, and then you're handed the bill. But right as borrowers reached for their wallets, the pandemic hit. The government stepped in and told 40 million people they didn't have to pay a single dime toward those loans for 3 full years. People took that $300, $400, or $500 a month and immediately redirected it. They used it to pay rent, buy a used car, or keep up with the bills. Over those 3 years, inflation hit hard. Groceries and rent became significantly more expensive. Whatever extra cash flow people had from that loan pause, the cost of living completely ate it. Then the pause officially ended. The 3-year grace period vanished, and the government asked for its money back. But the money was gone. Borrowers couldn't simply find an extra $500 a month because their budgets had already fully absorbed that cash just to cover the basics. When payments were turned back on, the financial world braced for a widespread collapse in consumer spending. Economists were sweating, fearing the sudden drain on household wealth would stall the entire economy. This graph illustrates exactly what the experts predicted, a sharp plunge in spending that would trigger sector-wide defaults the moment those bills came due. But the economy didn't stall. People just kept buying iced coffees, they kept traveling, and they kept spending. The predicted crash never materialized, in large part because millions of borrowers simply looked at the bill and walked away. They chose to keep spending on their lives instead of paying their servicers. If millions of people stopped paying their loans, why hasn't the data triggered a national panic? Why haven't we seen credit scores tank or aggressive wage garnishments? To prevent 40 million people from breaking the economy all at once, the Department of Education quietly launched a 12-month safety net called the on-ramp. Under this policy, missed payments were completely ignored by credit bureaus. Accounts were placed in default, and debt collectors were told to stay home. It's like telling a teenager they have a 10 p.m. curfew, but promising 0 consequences for breaking it. Borrowers realized there was no immediate punishment, so they prioritized rent and food over paying Sally Mae. The on-ramp successfully kept millions of actual delinquencies off the official record. The data looked healthy, but it was masking the reality that people simply weren't paying. But that 12-month safety net has officially expired. The training wheels are off. Missed payments are now supposed to start hitting credit reports, potentially ruining financial lives for millions of people. Yet even with the safety net gone, the systemic crisis still isn't showing up in the official default rates. That's because borrowers are migrating from simply ignoring the bill to jumping into a new kind of government lifeboat. To prevent a total collapse of the system, the government introduced the SAVE Plan, a new repayment mechanism with a very specific mathematical goal. The math is simple. If you don't earn much above a certain threshold, your monthly payment spins down to exactly $0. Because of this mechanic, millions of borrowers now legally owe nothing, and when you owe nothing, you can't technically default. This keeps the official default rate looking incredibly low and successful on paper, even though the debt itself hasn't gone anywhere. Politicians are taking a victory lap for managing the crisis, while the underlying financial pressure continues to build in the shadows. In the student loan system, a borrower with an $80,000 debt can have a monthly payment set at $0. This doesn't resolve the debt. It legalizes not paying it. As interest accumulates, the principal balance continues to grow. Millions of people are now living in this financial purgatory. They are technically current and in good standing with their lenders, even though they are contributing nothing toward what they owe. It's like telling a credit card company you can't afford the minimum payment, but asking them to report you as a highly responsible borrower anyway. If you want to see how these hidden financial mechanisms actually work without the Wall Street jargon, hit the subscribe button. We look at the money stories hiding under the surface every single week. By institutionalizing this cycle of non-payment, we have created a shadow default crisis that generates a massive illusion of national economic health. Even if you don't have student loans, this matters. The American consumer is the engine that keeps the economic machine running, and this shadow crisis is currently masking that engine's true condition. Meet Dave. He's an average guy with a stick-figure frame and a nice hat. To a bank, Dave looks like a success story. In Dave's credit score model, a zeroed-out student loan means no defaults. That $0 payment is the pillar holding his score artificially high. Banks see a green light, approving a mortgage and $60,000 auto loan, unaware his foundation rests on a temporary government program. In reality, Dave is financially redlining. He is maxed out, surviving daily life only because that $500 student loan bill isn't currently hitting his bank account. If the courts or the government change the rules and that $500 bill returns, Dave's budget breaks. He can't pay the car loan or the credit cards, revealing that his entire financial life was built on a false floor. This isn't just Dave's problem. It's a structural risk to the entire credit system because student debt isn't isolated. It is entirely foundational. In this consumer debt hierarchy, student loans are the foundational bottom block, supporting auto loans, credit cards, and mortgages. Instead of fixing the instability, the government uses temporary administrative pauses to keep that bottom block from sliding out and toppling the layers above it. The government built lifeboats like the Save Plan to keep millions of borrowers from entering official default. But those lifeboats are currently caught in a legal tug-of-war. Federal courts have been blocking, unblocking, and pausing these plans for months, leaving the entire system in a state of chaos. This has left millions of people in administrative forbearance. It's a polite term for a system so broken that the government has no choice but to freeze payments while they figure out what's legal. When people are confused, they stop paying entirely. The risk to the system hasn't been removed. It has simply been frozen in place by bureaucratic gridlock. Right now, we have a mountain of debt that borrowers cannot afford to pay. Yet the official narrative from politicians and spreadsheets is that the consumer is strong and the economy is fine. We are watching a scenario where the debt is still very real, but it's being treated as invisible because it's not currently being collected. This frozen state cannot last forever. Eventually, the courts will reach a final decision, and the administrative grace periods will run out. When that unfreezing happens, millions of people will suddenly face a financial cliff, the immediate return of bills they haven't budgeted for in months or years. When those millions of borrowers hit that cliff, their inability to pay will ripple outward. The resulting defaults on those auto loans and credit cards won't just affect the borrowers, they'll hit the banks and the broader consumer economy that was built on top of them.